Have you ever looked at your monthly car payment and wished you could make a very large portion of it simply vanish, even for just a little while? What if I told you there was a method that could potentially reduce your immediate out-of-pocket expense to a mere fraction of the total bill? This is not magic, but a financial strategy that requires disciplined knowledge, a clear understanding of the rules. The concept is called the flip-flop method, and it relies on something I call OPC, which simply stands for Other People's Credit. In this case, other people refers to the financial institutions behind your credit cards, and we are going to learn how to use their credit responsibly to give your personal cash flow some breathing room. The core idea behind this strategy is both simple and powerful. Instead of paying your entire car note directly from your bank account each month, you pay only a small portion of it yourself. For the much larger remaining balance, you leverage the credit available to you on your credit cards. You are essentially telling the credit card company, please cover this portion of my bill for me this month. In exchange for this service, you will pay them a small fee in the form of interest. This allows you to keep more of your own cash on hand for other needs, effectively using the credit card as a short-term bridge to manage a large, recurring expense. It is a powerful tool when used correctly. This method is not about erasing your debt. Let me be very clear about that. It is about restructuring how and when you pay it. The debt still exists, but you are shifting the immediate responsibility for the bulk of it from your checking account to a credit card's balance. This flip from your cash to a card's credit line is the first half of the process. The flop comes later, when you manage and move this debt to maintain the advantage. The goal is to make your large car note feel, on a monthly basis, much smaller. Think of it as breaking one big payment into a tiny cash payment and a manageable credit card balance that you will handle separately. So, what is the promise here? The promise is that by understanding and applying this method, you can potentially take a significant monthly expense and dramatically reduce the immediate cash required to satisfy it. In the example we will explore, we will demonstrate how you can bring your monthly costs down to just 1/8 of the original car payment. This is not a free ride, and it requires you to be an active, informed manager of your own finances. But for those who are diligent, the flip-flop method using OPC can provide a level of financial flexibility that can make a real difference in your monthly budget and your peace of mind. Before you even think about using a credit card to pay a bill, you must understand the most important rule of the credit game, the 30% utilization rule. Your credit utilization ratio is one of the most significant factors influencing your credit score. It measures how much of your available credit you are currently using. Never let the balance on any single credit card exceed 30% of its limit. For example, a $1,000 limit means keep the balance under $300. This shows lenders you're a responsible borrower. Violating the 30% rule is a red flag to creditors. It signals financial distress and can lower your credit score. As you employ the flip-flop method, this rule is non-negotiable. Have enough available credit across one or more cards to absorb your car payment without pushing any single card's balance over 30%. This is the foundation of the strategy. Ignore it and you could do more harm than good to your finances. Now, let's talk costs. Using OPC is basically renting money. You pay rent with fees and interest. The most common cost is the annual percentage rate, or APR. APR is the interest you pay on the balance you carry. There are also transaction fees to account for. Cash advance. Expect a cash advance fee, typically a percentage of the amount, or a flat fee, whichever is higher. You might also pay an ATM fee if you withdraw cash. Alternatively, with a balance transfer, there is often a balance transfer fee, usually a percentage of the amount moved, typically between 3% and 5%. Even if balance transfer interest is lower or introductory, the upfront fee is immediate cost. Understanding every potential fee is critical. APR transaction fees, any other service charges. Read your card agreement with a fine-toothed comb so you aren't surprised by hidden costs that could undermine your strategy. Let's put this into practice with some real numbers so you can see exactly how this works. Imagine your car note is due. After paying your small portion, you need to cover the remaining $260 for 1 month using a credit card. We will compare two common methods for accessing your credit. These are often attractive because of promotional low interest or 0% APRs. For our example, we'll use a standard 15% APR. To calculate monthly interest, we find the daily rate. 15% APR is about 0.11% per day. Over 30 days, interest on $260 is about $3.22. At the end of the month, your total balance would be approximately $263.22. Remember to account for any balance transfer fee. It could add $8. It could add $13 right at the start. Factor the upfront fee into your 1-month cost comparison. Now consider the second scenario, a cash advance. This is almost always more expensive. Approach with extreme caution. Cash advances typically have a much higher APR. Interest often starts accruing immediately with no grace period. For this example, we'll use a cash advance APR of 34.24%. Daily rate is about 0.0938%. Over 30 days, interest on $260 is about $7.42. Total after 1 month would be approximately $267.42 before other fees. Cash advance fees are almost certain. It could be 5% of the amount, which here equals $13. You may also face an ATM withdrawal fee of a few dollars. Adding all costs together makes the cash advance significantly more expensive than the balance transfer. Balance transfer, including potential fee, might cost around $11 or $16 for the month. Cash advance could easily cost over $20. The numbers speak for themselves. They show which option is more financially prudent for your plan. When we lay the two scenarios side by side, the conclusion becomes strikingly clear. For covering our $260 portion, the balance transfer is the more financially sound option. Even assuming a standard APR and adding a typical transfer fee, the total cost remains lower than that of a cash advance. The cash advance, punishingly high APR that starts immediately multiple layers of fees, proves to be a far more expensive way to borrow. The difference might seem like only a few dollars for a single month, but these dollars add up over time and represent money that should be in your pocket, not the bank's. Therefore, if you are going to employ the flip-flop method, your primary tool should be a credit card that offers a low-interest APR, or, ideally, a 0% introductory APR on balance transfers. This is the key to making the strategy work. You flip the car payment balance onto this card, paying only a small transfer fee and minimal to no interest for the promotional period. Then, before that period ends, you either pay off the balance or flop it to another card with a similar offer. This requires careful planning and a good credit score to ensure you can qualify for these offers when you need them. It is an active process, not a passive one. However, I must end with a strong word of caution. This is not a strategy for everyone, and it is certainly not a set-it-and-forget-it plan. The flip-flop method is fraught with risks if you are not disciplined. The biggest danger is letting those balances grow. You must have a concrete plan to pay off the entire debt. If you miss a payment, go over your 30% utilization limit, or fail to manage the end of a promotional period, the consequences can be severe. Late fees, penalty APRs, a damaged credit score can quickly turn a clever strategy into a financial nightmare that costs you far more than you ever hoped to save. In conclusion, the flip-flop method, using OPC through balance transfers, can be an effective tool for managing monthly cash flow by dramatically lowering your immediate out-of-pocket expense for a large bill like a car note. As we've seen, it's possible to reduce your cost to a fraction of the original payment. But it demands that you honor the rules. Stay under 30% utilization, read all the fine print, track every fee, and always have an exit strategy. You must be the master of your debt, not the other way around. Use this knowledge wisely. Act with intention.
If you found this video to be informative, you can get your free Way to Pay Less form and car loan logbook posted in the description. Please smash that like button, hit that notification bell, and subscribe to the channel for more videos.